The views and opinions expressed in this broadcast do not necessarily reflect or represent the views and opinions of WBGR Network. Any questions or concerns about what is said should be directed to the show host, whose information will be provided upon request.
Hello everyone, welcome back to Let's Talk Money 2020. Today is July. The days are running to each other. It's July something 2020, put it that way. July 24th, I think it is. But it's a normal Friday talk. I thought I'd kind of slow down a little bit. A lot of times when I present, there are certain concepts we talk about that probably are a little bit more advanced. I think after this week and really talking to some clients about certain topics, I think I need to slow down just a little bit and really just talk more simplistic. Some things, being an accountant and being a CPA, we take things for granted. We take things for granted, and we think that people know what we're talking about. But that might not necessarily be the case. It might be a number of reasons why you're really not really grasping onto whatever you see on YouTube or whatever you're reading or whatever. It might be a number of factors for that. It could be, your level of understanding. It could be the person who's actually doing the talking. His level of understanding is so intense that he doesn't realize that he's losing his audience because he's talking so far above his audience. So I want to slow down just a little bit and talk about something that I think that all of us really could really relate to, even myself at times. And that's basically understanding financial statements. And we kick that term out there a whole bunch, but I think it's better to understand how financial statements can really improve our lives and basically give us a level of understanding about financial statements that we never had before. We can make better decisions. So I think it's good to just kind of slow down a little bit and go back to the basics. Because to be honest with you, the key to wealth is really just repeating and perfecting the basics. Nothing really complicated. If it gets too complicated where you can't explain it, to your 12-year-old child, then you probably are doing something just a little bit too complicated and probably won't bear you too much fruit. You'll probably be wasting a lot of time. But certain things are very basic. Understanding financial statements is a very basic ability, but it just takes practice. It takes really contemplating and doing a really thorough, thought process when it comes to just looking at looking at the financial statements and kind of deciphering what's behind those financial statements, and really not get too overwhelmed, because there are a lot of terms, there are a lot of statements, a lot of pages, but they basically boil down to just a couple of concepts, really. But those concepts can get more and more sophisticated. You can actually, after you've seen like the basic income statement, you can dwell into it a little bit deeper and make certain relationships. There's always a story behind each number. So my goal is really to really show the basics and kind of drill down into the basics, where you have a better understanding. You can understand relationships. You can understand why certain things are on the financial statement. So let me just go on and move to our next slide here. There might be a lot of reasons why you might want to understand financial statements a little bit better. You might want to make an investment, for example. you want to invest into the stock market. It's one thing to just listen to people, and I don't listen to a lot of people. I watch the was that CNBC? I watch that all the time, almost every day. But it's one thing to just listen to people, and you might see a hot stock that's really smoking right now, and you want to put your money behind it, but it's got to be more than that. You got to dig a little deeper and look at the financial statements. You got to look at who's running the company, what the philosophy is, what their outlook is, where they were yesterday, regulatory issues, news issues, lawsuits, takeovers. There's so many things that you could actually learn about that really can help you to make a better decision as far as what to really invest your money into. But really, it goes down to the core fundamentals, and Warren Buffett says the same thing. It's the core fundamentals. It's really looking at the financial statements, understanding the financial statements, and getting a better understanding of the business. So the second reason is you might want to make sure your own financial statements are tight. So I've seen all kinds of financial statements from good to just not so good, but you might want to take what I'm really talking about here and just try to improve on your own financial statements. You don't have to try to swallow everything at one sitting, but if you could just take a little bit out of what I'm saying and then apply it to your own financial statements, then you'll be a little bit better off. So what I'm giving you here is not something that would actually take you from a one day or one session just listening to me talk about financial statements to you being an expert. That's not going to happen. But I tell you what, you can have a decent conversation with somebody, and really that's the starting point. So potential buy. You might. We've actually helped clients actually buy business and sell businesses. But if you're considering buying a business, then you got to understand the core financial statements. You got to be able to look at them and say, something ain't right here, right? And then I'll give you more points as we go on. I probably would take about several weeks to go over understanding financials, because there's so much that you could really get into. But you can basically look at certain things and you can say, oh, wait a minute, this is not right. I know how financial statements work. I know that I know what good liabilities are. I know what bad liabilities are. I know what my equity section should look like. I know if I were to look at your revenue and look at how much you're charging per widget, I should know how much your growth should be. I should be able to make some estimates. I should be able to infer certain things about your financial statements that will really back up what you really put in, what this person's really putting on paper. Because I've seen a whole bunch of stuff. You've seen, pie in the sky financials, and most of the time, it's just like your parents always tell you that, if it looks too good, then most of the time it is too good to be true. So same thing with financial statements. If they look too good to be true, trust me, they're not the real deal. So next thing is loans. You might want to really get a loan on, let's say whether it's rental property or your business or whatever. So your financial statements have to make sense. Lenders look at something completely different than an investor would look at when it comes to financial statements. The lender is basically looking at your ability to pay him or her back, right? That's what a lender is always looking at. So they're looking at whether you've been profitable over a period of time, how profitable, and could you really, if they structured your loan, could you really make the loan payment? So that's a little bit different than what an investor would be looking like, what we're looking for. You just look for totally different things there. So you might be looking for a potential investor. So if you're looking for a potential investor, then your financials have to be really tight, and you really have to make sense. And they're not saying certain things could mean something else. I've been in this business for a long time, and I can just glance at financial statements and I can say, oh, wait a minute, that's a little area of concern. I'm not saying that most of the times that don't do the deal, but there are certain things that might strike out at you when you look at the financial statements, and you can basically make certain conclusions, and most of the time those conclusions will be right. So also measure performance, profitability, EPS, earnings per share, a whole bunch of other measures that you can actually look at and really make certain assessments of people's financial statements. So well, let me just keep moving here because I'll start talking, and the next thing you know, I won't be able to stop. So we're going to just talk about the basics here. The income statement. You hear certain terms for income statement of income, or P&L. I think QuickBooks calls it P&L, but basically it's the same thing. Income statement, P&L. P&L stands for profit and loss, right? And at the end of the income statement, you're either going to have a profit or you're going to have a loss. So basically, there are different names for the income statement. I think in nonprofit, statement of revenues and expenditures and other fund balance and fund balance or something like that. But there are many different variations. But they're basically trying to say one thing: what are your revenues? What are your expenses? What are your taxes? Extraordinary expenses, net income, earnings per share, the number of stock you have outstanding. They're basically saying the same thing. So the thing you want to remember about with the income statement is it is measuring the performance over a certain period of time. All right, and that certain period of time might be a week, it might be a month, it might be a day, it might be a quarter, it might be 6 months, it might be 3 months, it may be a year, right? So the income statement, this is a very important concept, and I can't oversimplify it. It's basically your performance over a certain time. So, for example, cash. If I say how much cash I have in the bank, it doesn't give me an indication of time. It just gives me a measure of what's in my bank at that particular time. That's not what we're talking about here. We're talking about your revenues. We can say, okay, well, what were your revenues over a period of time? Whether it was a quarter, a year, or whatever. What are your expenses over over a period of time? What are your taxes over a period of time? What are your extraordinary expenses? By extraordinary expenses, I mean expenses that are not a part of the normal operating cycle. Like, for example, you might have a plant or office shut down because of some catastrophe or something. That will be an extraordinary expense. You might have some one-time purchase, huge purchase, or just something that just happened, and it was just a one-time thing. So that's your extraordinary expense. And the reason why you want to separate those is because you want to see what the business is doing on a day-to-day basis, right? On this normal course of operations, and you want to separate out the things that are extraordinary. So, I mean, that's the only explanation that there is when it comes to regular expenses and income and whatever, and extraordinary events, right? And then your net income. You can measure your net income over a period of time. You can say, hey, what is my net income per month? What is my net income per quarter? What is my net income from 6 months? And what is my net income for a year? It's just that simple. So certain things would not be considered income, right? Or on the income statement. For example, equipment. You can't say, what was my equipment over a period of time? It just makes no sense, right? What are my liabilities or over a certain period of time? That makes no sense. But you could say, what are my liabilities as of a particular day? What is my equipment balance as of a certain day? You could say, what is my cash as of a certain day? So cash, equipment, liabilities, those sort of things are not on the income statement. Those are on the balance sheet, in which I'll get to in a minute. But just sticking to the basics here. So the things that you can measure over a period of time: revenue, expenses, taxes, extraordinary expenses, net income. Those are things that you can recognize over a period of time. All right, so hope that's simple enough. So I don't know whether you can see this too well, but what I did was I picked one of the really, really hot companies on the market right now, and that's Tesla. And I thought I was actually copying in the second quarter of 2020, but after I got the PowerPoint presentation together, I realized that it was the second quarter of 2019. But as next week, I'll probably pull up the second quarter or second quarter of 2020 2020, because it's very important. I pulled that one up. But I don't know whether you can really make this out, but the first part that I have here is revenues at the very top, and then I start to really list out. Tesla actually lists out the type of revenues. For example, they have automotive sales revenues, automotive leasing revenues. They have energy generation and storage, supplies and others. So they're basically listing out their types of revenues. So you'll see a small number on the right. It might say automobiles revenues 5,168. That does not mean that their revenues are 5,168. This is what kind of confuses people. No, these numbers are into the billions. So the way to really read this is they had $5,168,000,000 dollars in revenues for the second quarter. Automobile leasing, they had $208 million in automobile leasing. So it used to be Tesla did not actually lease vehicles, but as time went on, they started to lease vehicles. So you see here the lease revenue is $208 million as opposed to $5,128 million for sales. So if you look on the streets, you can really tell that Tesla is really kicking butt out there on the street. You see so many cars on the street that are electric. My car is electric, but I did not buy a Tesla, and I bought my car several years ago. And the reason why I did not buy a Tesla is because really the market had me kind of spooked out. At that time, Elon Musk was actually going through investigation from the SEC. He wasn't able to make his payments to his suppliers, the people that are building the cars. There was all kinds of negative news. So, I was really unsure about, the life of Tesla. So it tells you that, even me, I can't tell you what's going to happen in the future. But I tell you what, I should have just said, okay, I believed in the company, which I did. I followed Tesla for a long, long time. But I didn't actually buy that car. But looking back now, I wish I had bought the car. As you see here, they add up their total revenues. There are different types of revenues. There's some energy generation and storage. They make $369 million off of that. I don't know what that is. Probably does something dealing with the batteries. They probably sell batteries to some people. Services and other. So basically, if you look at their financial statements, you'll see these financial statements, and then when you read their reports, their quarterly reports and their annual reports. The quarterly report is called a 10Q. The annual report is a 10K. So if you read their reports, they'll tell you a little bit more about what makes up all these things and where they're going, a little bit of history of each one, and what they think the future holds for each one of these types of revenue. So when you see the financials, you look at the financials first. I would recommend looking at the financials first, and then going back and trying to read about each one of these line items in their financials. So, there's some other. I'm sorry. Then you go into cost of revenues. Now, the cost of revenues are the costs associated with the direct costs when it comes to actually putting your product on the market. So, automobile sales, they actually have cost of revenue. This is what it costs to actually produce the car. Automobile leasing, they have a cost to actually lease those automobiles. So the cost of the items that you're selling, it shows up in the cost of revenues. And then for the energy generation, they have costs, and service and other, they have costs too. But once you subtract out the core costs or the direct costs from the revenue, you have what's called gross profit. Don't be confused. This is not the net income. This is the income after you've taken out the direct costs. The direct costs are the costs directly associated with producing that product or service. So in Tesla's situation here, it's the actual cost of actually producing the cars. And then you have what's called operating expenses. So your operating expenses are expenses that are not directly related to production of the car. So let me go back to the direct expenses. So direct expenses basically increase with the increase in the number of revenue associated. So just take a car for example. If Tesla is selling a car for say $60,000 and the cost to actually produce that car is say $20,000, then if they sell 2 cars at $60,000, the direct cost or the cost of goods sold is going to be $40,000, right? So 2 cars, $20,000 a piece. $40,000 is the cost to actually produce the cars. So that would be in the cost of goods sold section. But they also have other types of expenses, right? They have like advertising. Let's just look at them. They have. I want to just put them under selling, general, and administrative. They have, they have a front office. They have salespeople. They have depreciation. They have all kinds of stuff that are not associated with the direct cost of actually producing the car. Those would be operating expenses. Okay, so right after you have the gross profit, you take out the operating expenses. All right, so what's left is your income and loss after operating expenses. And then, let me just tell you why you want to have those 2 sections there, the gross profit and the income and loss from operations. Okay, I might be looking at, for example, what it costs to actually produce a product or service. And I might be focused on whether my costs are too high. Maybe they need to import certain costs. They need to do certain other things, robotics or whatever, to get the cost to actually get the car into the market. So I may be focused just on the cost of goods sold, right? Or I might say, hey, look, after my cost of goods sold, after my cost to actually produce the car, what are my normal operating expenses to get the car to market? So I might be more interested in the income or loss from operations. So that's going to give me the cost of producing the car, and it's going to be the cost of actually selling the car too. And I went over some of the things that are in the operating expenses. All right. So from a financial standpoint, I might be interested in the next section, and that's the next section. The next section is the cost to actually borrow, or my interest income that I'm actually generating every year. So I have a cost to actually borrow to actually produce these cars. So I have another section that will break out the interest income and the interest expense. So in the beginning, Tesla was heavily leveraged. What I mean by leverage, they borrowed a lot of money to actually produce their cars. So the interest expense was extremely high. But as you can tell here, the interest expense has gone down a lot more. So that tells me that they're doing a better job of maintaining their debt. They're doing a better job of actually getting, actually regenerating the profits, and they're actually keeping the profits in the business to help them actually produce more cars, as opposed to have to borrow on credit most of the time. So when you have high interest expenses, it means that your production costs and your other costs are pretty much leveraged, and it could be a sign of trouble for the company. But when you see that the interest expense is really relatively low, then you know they're not really borrowing to actually produce their particular product or service. They generate enough they're generating enough revenue now to actually self-fund their business, and that's where you want to be. You want to be at a point where you don't need to rely on borrowing to actually produce your product or service. So the next section is a very important section, is the provision for income taxes. So they have to put a estimate of what the income taxes would be based on the revenue so far. So the income tax level, actually it's a minus number. So what that means is they've actually lost money over the prior years. So they wouldn't be probably paying income taxes for a while, because they can take those net operating losses and roll them forward into future periods. So if you were looking at this thing from a pure investment standpoint, and you were trying to say, okay, well, how much in taxes will they be paying in the future? You want to start looking at how much money they lost in the past, and you can start to extrapolate out, well, when will they start to pay income taxes? Because that's going to affect the bottom line, and it's going to affect the way that the company reports its profitability, right? So that tells you certain relationships, and I'll get deeper into this in future broadcasts. So then you have your net income right after your provision for income taxes. That tells you the net income. So for the second quarter, the net income was a loss of $389 million. This is for the second quarter. However, we're in the second quarter of 2020, where they've already shown 4 straight consecutive periods of profitability. So now they're going to be, I guess, eligible to actually be on the New York Stock Exchange. So, be one of the S&P, the big S&P companies. So it's going to be quite interesting, because they're going to move from the Nasdaq up to the S&P. So that will happen really soon, because they just had the 4th quarter of consecutive profits back in 2019, is which we have on the screen here. They were actually losing money. So the next section is your earnings per share. Basically, this is, as a stockholder, you want to know, if I took the earnings and divided that by the number of shareholders that are totally outstanding for the company, you want to know, what is your share of the company? What is your share of the net earnings of the company? So that's all that really means. And then you have basic and diluted. I can get into basic and diluted some other time, but the basic one is what you really want to be, really what's important to you. The basic earnings per share is 2.31. It's a minus 2.31, and it's a minus for diluted. So I won't get into those things. I think I'll be complicating issues. And then you have a section on here for the average number of shares outstanding. Why are these things important? Because you, as an investor, you want to know, okay, basically from a owner's perspective, how much of the revenue is really, you won't get that amount, but you want to know how much of their earnings is really set aside or really looked at as being allocated towards the shareholders. You won't necessarily get that money, because you only get the money if there's a dividend actually declared. But this is one indication of how profitable companies are, as far as what is their earnings per share. It's basically, what are my earnings per the number of shares, total shares that we have outstanding. So that's basically how that's the I guess the composition of the basic income statement. And in future broadcasts, what I'm going to do is I'm going to stick with Tesla, because Tesla is hot right now, and it's been hot all year. But I'm going to stick with them. I'm going to go back historically, and we're going to see how they were performing back in the past. So you can see some of the struggles they were having, and we're going to look at now. So now they have a very healthy looking balance sheet, a very healthy looking income statement. So, you know, I want to walk that progression so you can really understand the relationships between certain accounts on the income statement and balance sheet and other things. So with that said, I'm going to take a break. We're going to come back, and we already looked at the P&L or the income statement. See, there's another name. See, they call it the statement of operations. So you're gonna see this name of the statement used in many different ways, but it all means the same thing. There is no difference between the income statement, statement of operations, P&L. There's really no difference. It's just you're measuring performance over a certain time. So you're measuring the sales over a certain time. You're measuring the gross profit over a certain time. You're measuring the net income over a certain time. You're measuring the earnings per share over that particular period of time. So don't get it confused with the balance sheet items. With the balance sheet items, just measure things on a particular date, right? So this is just the performance over the second quarter, which you're looking at right now, in the second quarter of 2019. So when we come back, I'm going to go over the balance sheet real quickly, and I'm going to go over the statement of cash flow quickly, because those are the three statements that they're really core fundamental statements that you should really understand. There's certain other statements, but these are the three core. If you talk to any accountant, that's what he goes to school for. He learns how to do the income statement, balance sheet, and cash flow. So when we come back, we'll go over balance sheet and cash flow. Stay tuned.
All right, your girl Kia, I'm comedian Court. We are here, huh? We're here at Mickey D's. We're gonna try the new chicken sandwich.
It's so processed. What? Chick-fil-A could never.
Alright. What's missing?
Everything.
I'm comedian Koi.
I'm Kia, special guest.
Until next time on the Breakfast Mojo. Who knows what will end up next?
Never know.
Okay, we're back. So a few minutes ago, I just talked about the income statement or P&L or statement of operations or whatever they want to call measuring over a period of time. All right. Next, we're going to talk about the balance sheet and the cash flow statement. So the critical thing to really remember about the balance sheet is it just gives you a reflection of the company on a particular date. All right, so you're going to see whole different accounts. Remember on the income statement, you saw revenues, you saw expenses, you saw net income. You don't see any of that on the balance sheet, right? You're just looking at what are my assets. Assets could be cash. They could be investments, marketable securities. They could be accounts receivable. The assets just represent some type of future economic benefit, right? So cash is a future economic benefit, right? Accounts receivable, it's a benefit because in the future you will be receiving some cash. Investments, you can cash those investments in the future. Just there are all kinds of assets, but the key thing is assets really provide some type of future economic benefit, right? And what you do is you measure them on a particular day. You never say, well, how's my cash doing over a certain period of time? I mean, this doesn't sound right, but you could say how much cash that I have in the bank, or what is my investment balance? What is my AR balance? You never say, okay, well, what are my receivables over a period of time? Nobody knows what you're talking about. You can say what are my receivables are now, or what it was at the end of 2019, or at some particular date. So the income statement always shows you measures on a particular date. That's the key thing you want to remember. And the assets, they always equal the liabilities plus the equity. So I define what the assets are. Liabilities are things that you owe other people, right? Things you owe other people or the companies. Could be the owner itself. It could be just about anybody. A municipality. It could be the IRS. These are balances or monies that you owe someone else. There are some other things that might not necessarily be money that you would owe, but I'm not going to get into that today. But from the core understanding, the liabilities are amounts that you owe, your company owes, of the people, of the companies, jurisdictions as far as taxes. It's whatever you owe. That's the liabilities, and those liabilities could be current liabilities or they could be long-term liabilities. Real simple concept. The current liabilities are liabilities that you got to pay within the next year. The long-term liabilities are liabilities that you have to pay after 1 year. It's just that simple. So in the future, I'll break down the balance sheet. I didn't want to bring it here. I didn't want to talk about the balance sheet because I talked about the income statement in great detail. I'll talk about the balance sheet next week because I think it's just too much for one sitting. All right, so the equity is what your ownership is in the company, right? So you as an owner, if you just suppose it's a big company, the equity section is where you're going to find the stockholders' equity. That's the investments that the stockholders that have actually put into the company. And whenever you put something here, it's an investment, right? It's an investment that others are making into your company. It could be yourself that's making the investment into the company. So that's the equity portion. Don't let any of this confuse you. It only means this is what the owners owe. What the owners own of the company. The liabilities are what the people who lent you money, what is their portion of the company, right? And I say what their portion is not necessarily an ownership portion. It's just you owe that money to those people. So if your company were to go belly up, for example, and you only had assets and you only had liabilities, well, you got to take care of those assets. You got to take care of those liabilities with the assets that you have. So whatever you have left after you take care of the liabilities goes to the owners. That's all that means. So there's a basic equation: assets equal liabilities plus equity. Or you can do it another way. You can say, I remember algebra, you can say assets minus your liabilities equal your equity. So the equity portion is that portion of what the owners owe. This is very important because when you look at a company, you want to know, okay, are they heavy in liabilities and light on equity? That can tell you one thing, that the debt service is going to be very high when it comes to this company. So when you look at the income statement, you're going to see very high interest expenses. So you don't want to be investing in a company that has seriously uncontrollable debt, because a lot of the cash goes to take care of that debt. So you want a good mixture. You want basically a lot of money invested in this company through the equity section, and if you have to have some debt. Most companies have some debt, but you want your debt to be manageable, but you want your equity section to be really strong. That means that if something were to happen, then you got plenty of cash on reserve. You got plenty of just backup money. You have certain reserves that are there that can actually get you afloat if something were to happen to the company. If you have strong equity, you can have strong liquidity or assets through liabilities as well. If you have a serious line of credit, the only problem is you got to pay it back. You have an obligation to pay it back. In the equity portion, the company does not have a liability or a obligation to pay you back. It's only based on the performance of the company. So if the company performs well, you can reward the equity shareholders. So if the company does not perform well, you don't have to reward the equity shareholders. It's just a risk that they're taking. However, with liabilities, you got to be careful because, like I said before, if you have lots and lots of liabilities, then you got to pay those monthly bills. You're obligated to pay those monthly bills, so that might have a bearing on whether you invest in a company or not, or whether you buy liabilities. How much in liabilities do they have? Because if you buy the company, then the liabilities go with the company. The liabilities become your liabilities. So you got to be careful when you look at financial statements, especially if you want to go buy, say, a small business, and they have huge, say, IRS debts. Well, you got to be careful because when you buy that company, the IRS debts go to you now because you're the new owner. So if you see large debts there, you got to say, whoa, wait a minute, you got to take care of these debts before there can be any purchase of the company. But keep in mind, once they pay those liabilities off, now you start to think now the cash that was up here in the cash section is going to be gone because they actually have paid off all these liabilities. So, under rare occasions do you actually buy a company that's just heavily in debt, because those debts become your debts. If you have the ability to go in and negotiate those debts and get them down to pennies on the dollar, then okay, this sounds like a better investment. But just to buy a company that has huge liabilities and you take on those liabilities now is not a good picture for you. So again, the balance sheet really reflects your financials on a particular day. What is my cash for the day? What is my liabilities for the day? What is my investment balance for the day? What is my equity? What is my equity today? All right, so there's one of my favorite. This is my favorite statement here. My favorite statement is the cash flow statement, because the cash flow statement basically shows you how the cash comes in, and it basically shows you how the cash goes out. Basically, listen to what I'm saying. I'm saying this: the cash. You're following the cash. So you're going to have cash from operations. You're going to have cash from financing your business, and you're going to have cash from the investors, right? So it's three basic sections there. That's the cash from operating. That's the cash that you generate, say in Tesla's case of selling cars. This is the cash that comes in, and then you're going to have the cash from financing, right? So if Tesla borrows money, that's cash that comes in, and if they have to pay the debt down, that's cash that goes out. So this is my favorite statement because it measures cash. Where I'm following the cash. So I like to see lots of cash generated by operations. I don't like to see cash generated by, say, loans. And in most cases, I don't like to see lots and lots of cash generated from the investment side either. I want to see how great the company's doing, so I want to see the cash is generated by its operations. That's the top part of the cash flow statement. And in future broadcasts, I'm gonna break out these statements, and I'm gonna make it more and more clearer. So just hang in there with me. Just hang in there with me. I just don't want to just overwhelm you on one setting. I just want to talk about the basics here on one setting. So the cash flow basically goes over a period of time. It shows you how the cash comes in and how it's spent over a period of time. It's not just like the balance. It's not like the balance sheet where we're looking on this on a particular day. We're looking on a monthly basis, quarterly basis, yearly basis. How is the cash received? How does the cash go out? This is my absolute favorite statement because it tells everything. When I want to know about a company, I want to know what is it doing with its cash. How does it get its cash? How much cash is it generating, and how much cash is it pumping out? That's the bottom line. That's what I want to know. Now, most people they get excited when they see the income statement. They want to know how much revenue we're making, how many expenses we got. No, I like to see how much cash the business got, because the bottom line to me, I just cut the chase, right? I'm like, oh, well, how much cash does this business got? In order for me to invest in it, how much cash do they have? Do they generate cash? Do they really generate cash? They don't generate cash. Me, hey, look, I'm staying clear of them because we're all in business to generate cash at the end of the day. Right? You can call it revenue, you can call it whatever you want. But at the end of the day, we want to know how much cash can come in. Because let's face it, you can sell a lot. You can send a whole bunch of invoice out, but is the cash coming in? Right? So that's what you got to understand. I mean, you can send a whole bunch of bills out, just like say most jurisdictions when it comes to parking or moving violations. They send these violations out, but what good is it if they send the violations out if they can't collect on it? So the cash flow statement shows you how the cash comes in, how much cash is coming in, and how much cash is going out. That's basically what I want to know. When I run my business, I look at the income statement. The income statement is nice, it's pretty, it's nice, it's beautiful, right? But I want to know how much cash are we generating? How much cash are we spending on a day-to-day basis? That's what I want to know. That's the bottom line for me. This is why this is my favorite statement here. And what we'll do is we'll go into it. I didn't go into it today because most people, they look at the income statement, the statement of operations, and it tells the full story for them. me, that I don't stop at the income statement. I look at it. Oh, it's nice, beautiful, okay, or whatever. But the real deal for me is what the cash flow statement is doing. How much cash is going in? How much cash is going out? All right. So next time we'll analyze the financial statements in deeper detail. And we'll start to look at some companies that are good as far as their financials, and companies that are not so good. So basically what I'm going to do, I think what I'm going to do is, first I'm going to take Tesla and I'm going to show you the days that they were not good, right? And to show you some of the things that you could have seen in the financial statements that prove that things weren't good. And then we're going to take them right now, which they're doing superb now. They're doing absolutely wonderful what they're doing right now. So we'll look at the financial statements right now in 2020, so you can so you can see certain relationships, ways certain accounts move, ways certain accounts are related to other accounts, and then you can basically tell after we get finished with our analysis whether companies are good buys, they're not good buys. Whether you look at your financials and see whether you need to work on certain areas with your company. Or you can look at whether when you want to get a loan, whether it's a good time for you to get a loan. But I always say, just to let you know, when it comes to getting a loan, that I think that you should start early as opposed to just waiting for some mystical day. Because even if you are declined, you can have the conversation with your lender. Well, I understand that I did not get it this time, but what would make my financial statement stronger so I could get it? So it gives you a little benchmark to really work towards. So that's my piece on loans. But we'll talk about that some other time. So these are the things that we're going to talk about in the near future. Again, there are some goals I'm trying to reach here. We're trying to understand financial statements for potential investors, to make sure our own financial statements are tight. If there's a potential buy, you want to go buy a company. Nothing wrong with buying companies. I love to see people buying companies. You don't have to start from scratch. Whether you want to get a loan, whether you want somebody to invest into your company, we really want to get into these financial statements. My goal is to really make sure that we all understand financial statements. We can look at a financial statement and we won't become overwhelmed. We can actually have certain opinions about financial statements. We can have some really healthy discussions with other business people, and when it comes to actually assessing stock, assessing whether a property is a good buy when it comes to real estate, you name it. We just want to make sure that we can look at those financial statements. We can start putting together projections or whatever you want to do, and we can actually understand thoroughly what we're getting ourselves into. Anyway, with that, have a good week. We'll talk to you real soon, and remember to come back next week, because we will be here. Talk to you soon. Take care.